Welcome to Pocket Power, where today we're diving into one of the most asked questions: which is the right mutual fund for me to invest in? If you're confused about where to start, don't worry. By the end of this video, you'll not only understand the different types of mutual funds, but also have two solid recommendations in each category to help you take that first step towards wealth creation. Before we delve into the various types of mutual funds, let's take a closer look at what is a mutual fund and how it works. A mutual fund is a type of investment vehicle that pools money from multiple investors like you and me to purchase a diversified portfolio of stocks, bonds, or other securities. Each investor holds units in a mutual fund, which represents a portion of the mutual fund's total holding. This way, we can access a professionally managed investment without the need to identify and buy stocks directly. Mutual funds are therefore an attractive option for both novice and seasoned investors. Now that we have a clearer understanding of how mutual funds operate, let's explore the different types available in the market. For those willing to take risks for higher returns, equity mutual funds invest primarily in stocks. The major benefit is the potential for substantial growth over the long term, thanks to the power of compounding and market gains. SBI Blue Chip Fund and Mirae Asset Large Cap Fund are great choices for long-term capital appreciation if you can handle market volatility. If you prefer steady returns with low to moderate risk, debt funds could be for you. The benefit here is the relatively lower risk and more predictable returns, making them suitable for short-term financial goals. Consider HDFC Short-Term Debt Fund and ICICI Prudential Corporate Bond Fund for short-term goals or regular income with minimized risks. Want a balance between risk and reward? Hybrid funds invest in both equities and debt. These funds offer the benefit of combining the growth potential of equity with the stability of debt investments. Axis Hybrid Fund, ICICI Pru Balance Advantage Fund offer growth potential with a safety cushion. For a hands-off approach, index funds track stock market indexes like the Nifty 50 or Sensex. The benefit here is low cost and minimal management, making them a great choice for passive investors. UTI Nifty 50 Index Fund and HDFC Index Fund. Sensex Plan are great for passive investors looking for low-cost options. For tax savings while investing in the stock market, ELSS is a fantastic option. The benefit of investing in ELSS is the tax deduction you can claim under Section 80C while still growing your wealth. Mirae Asset, Tax Saver Fund and Axis Long-Term Equity Fund. These funds offer tax deductions under Section 80C with a lock-in period of 3 years. Want to invest in gold without the hassle of buying and storing it? Gold funds invest in gold ETFs or gold-related assets. The benefit here is diversification and a hedge against market uncertainty. HDFC Gold Fund and ICICI Prudential Regular Gold Fund can hedge against market volatility. Thematic funds focus on specific sectors or themes like technology, healthcare, or infrastructure. The benefit is the potential for high returns if you strongly believe in the growth of a specific theme. SBI Healthcare Opportunities Fund and Mirae Asset. Great consumer fund can offer high returns if the theme performs well, but they come with higher risk. Now that we've covered the types, how do you pick the right one? Here are 3 key points to keep in mind. What are you saving for? Long-term or short-term? Can you handle high risk for potentially high returns, or do you prefer stability? How long do you plan to stay invested? Longer horizons are better suited for equity funds, while short-term goals can benefit from debt funds. Remember, there's no one-size-fits-all solution. The right mutual fund depends on your personal financial situation and goals. Choose wisely. Before you start investing in mutual funds, there are a few things you'll need in place. 1. You'll need a demat account to hold your mutual fund units electronically. It's like a digital locker for your investments. 2. Complete your KYC process with your PAN card, proof of address, and a passport-sized photo. Many platforms let you do this online. 3. Ensure your bank account is linked to your investment platform for easy transactions. 4. You can buy directly from the mutual fund platform if you already have a demat account, or else use platforms like Grow or Zerodha to start investing with as little as 500 rupees. To summarize, equity funds are for long-term growth, debt funds for safer short-term goals, hybrid funds for balanced risk, index funds for passive and low-cost investing, gold funds for market hedging, thematic funds for specific trends, and ELSS for tax-saving investments. The key is to stay consistent and not panic during market fluctuations. That's it for today's video. If you found this helpful, don't forget to like, share, and subscribe to Pocket Power. Comment below if you have any questions, and I'll be happy to help you find the right mutual fund for you. See you next time.